Someone recently over on our Patreon requested that I take a look at a stock that's done pretty well and has yet to experience a dividend cut, unlike a lot of their competitors. Additionally, their stock is offering a 13.5% dividend yield and has paid an occasional special dividend on top of their regular distributions. The company we'll take a look at today is Chicago Atlantic Real Estate Finance, ticker REFI. According to their website, it's a commercial real estate finance company that manages a diversified portfolio of real estate credit investments primarily in the GRAS space and is actively investing across the value chain. Chicago Atlantic is led by a senior management team with extensive experience in real estate credit, direct lending, risk management, and real estate acquisitions and development. Founded in 2019, their stock started trading in December of 2021. I'm gonna have to change some words for this video. I got in trouble with YouTube the last time I talked about a company that operates in this specific sector, so apologies for that. I'll try not to sound too obnoxious for this. But in a nutshell, this company originates mortgage loans to state-licensed growers of you-know-what. So as I just mentioned, REFI is offering some pretty appealing features. Its yield exceeds 13.5% according to Seeking Alpha, and they've never gone through a dividend cut. Let's take a look at their most recent results, which were published in November. They reported net income of approximately $11.2 million, or 56 cents per weighted average diluted common share. This represents a sequential increase of 21.7% on a per-share basis. In that same quarter, they also announced a regular distribution of 47 cents per share. This would give them a current dividend payout ratio of 83.9%. We'll take a look at all of their quarterly earnings since their IPO a little later. But all of this sounds pretty enticing for an income investor. They haven't grown their regular dividend since 2022, but they've paid a special dividend at the start of each year for the past 3 years now. This kind of investment could really snowball into something really great if you reinvest all of those dividends. But there's two things right away that investors need to keep in mind with Chicago Atlantic Real Estate Finance. We'll start with the most obvious point right now. The entire mortgage REIT sector is facing a really challenging environment at the moment, and they have been for a couple of years. These investments can suffer a lot when interest rates remain high for too long. We've been seeing a number of high-profile M-REITs go through dividend cuts over this past year. Blackstone Mortgage Trust reduced their dividend by 24% back in July. Ares Commercial Real Estate, a company that I sold a while back, cut their dividends in early 2024, also by 24%. Annaly Capital, Apollo Commercial, Two Harbors, and many other M-REITs have reduced their dividends since interest rates started soaring in 2022. Even the best-in-class mortgage REITs are feeling the heat right now. Starwood Property Trust and Arbor Realty Trust have payout ratios that are very close to 100%. It's unclear if they'll be able to maintain their distributions, but most of this sector has been getting crushed with high non-accruals and dividend cuts. But this hasn't happened to Chicago Atlantic Real Estate Finance. As we just saw, they're still reporting good numbers. The second concern is the industry they operate in. On one hand, it is exciting how much this industry is exploding right now. This is what it says on their website. Sales of the U.S. GRAS industry are expected to rival alcohol by 2030. Demand for financing in the GRAS market is expected to continue to rise due to recent and future state legalization of GRAS for medical and adult use, as well as an increase in consumer adaptation, with both trends requiring significant capital expenditures by operators. But then they also add the following. At the same time, the federal prohibition on GRAS use and commercialization hampers commercial and financial activities, creating a limited competitive environment for Chicago Atlantic in a highly fragmented market. Although their competition is almost non-existent, this is going to make expanding more difficult. If you only lend to one sector, that's going to limit your growth, even if this industry does see continuous expansion. There's also an added risk that no other mortgage REIT has to deal with, which is government regulation. Changes in policy could have dramatic impacts for this company if they go in the wrong direction. Then finally, I'd consider this sector a lot more economically sensitive. When recessions occur, luxuries and other things like that are the first things to get eliminated from their budgets. When people can easily grow the product themselves, people are going to be tempted to do that. That could lead to more borrowers struggling to pay Chicago Atlantic if that happens. So overall, this M-REIT does come with additional risks that no other M-REITs have to deal with, or at least to the same extent. However, all of these things considered, that doesn't necessarily mean this stock should be disregarded. Although I would not recommend making this holding anyone's largest position, it could still be an attractive investment if you are willing to bear the additional risk. Let's go through some of the most important numbers for these kind of companies to see what kind of financial position Chicago Atlantic is currently in. We'll start by looking at their non-accruals. These are the mortgages this company isn't earning interest from due to their borrowers being unable to pay the full amount. On their last earnings call, co-CEO Peter Sachs said that only one loan was on non-accrual. Although that does sound good, Chicago Atlantic's portfolio is pretty small compared to other M-REITs. They only have 35 loans in their portfolio with a principal balance of $362 million. For comparison, Blackstone Mortgage Trust has 149 loans valued at $19.3 billion. SAC reported that loan number 9 is currently on non-accrual, which is 4.5% of their portfolio. Given the current environment, 4.5% isn't bad, but you can see how much of an impact just one loan going on non-accrual can have for this company. If just one or two more were to go on non-accrual, it would be a really bad gut punch for Chicago Atlantic. Their loan terms are typically between 2 and 3 years according to their website, which is pretty short. The longer the term the better because you want to lock in borrowers for as long as possible. Their investments are well spread out across the US, and 3.7% of their borrowers have no real estate collateral involved, which I'm assuming is just one borrower. It looks like the single state operators are putting up more for collateral, which makes sense if they're a smaller operation. Real estate collateral coverage is at 1.2 on average according to this presentation, which is on the low end of what's typically accepted. To my knowledge, usually they want between 1 and 1.6% collateral coverage, so it does fit within this typical range. Here's a screenshot of how much the landscape has changed over the past 5 years. In 2019, using grass was legal in 35 states, 25 of which was only for medical purposes. Last year, 40 states legalized it, with an additional 14 states now allowing recreational use of it. This obviously helps this company a lot when it comes to finding new tenants to issue debt to. A quick look at their NAV per share shows that it's been very steady, which is excellent. We already saw they haven't been reporting any significant losses with their investments. If this metric was falling, it would indicate the value of their portfolio was shrinking. Then here's a chart of their earnings per share and their dividend distributions. The dark blue line is their earnings per share, and the light blue line is their dividends declared. We always want the dark line to be higher than the light blue line. If the light blue line is higher than the dark, it means they're paying out more in dividends than the company can afford to. You can see there's also a third line that shows up occasionally, which is a special dividend. These can be the result of a gain from one of their investments or some other one-time event. You can see it happens every year, or at least it has for the past 3 years. So it's possible the company might pay out any additional earnings they earned in the previous year for this special dividend, which happens at the same time each year. But you can see that their earnings were trending down for a bit, but they recently posted a big jump in their most recent quarter. It looks like they received the full repayment for 3 of their loans, which totaled $32.3 million. That's likely what bumped up their earnings in this quarter, and if it wasn't for that, then this number would have been lower, and I'm just curious how much lower it would have been. So overall, REFI is doing pretty decent right now. But again, this company comes with several additional risks that their peers don't. And considering M-REITs are already risky in and of themselves, especially in this environment, that's a high amount of risk with Chicago Atlantic. This falling trend in their earnings does concern me a little bit, and if interest rates remain high for longer, that'll keep the pressure high on this company. If you're the kind of person that believes the green market is going to continue to explode right up to alcohol sales like they predict, then that'll make the environment even better for this company. But in the end, I would consider REFI a speculatory position that could be worth it if you're okay with the added risk. And with that being said, that's going to wrap up today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.